All right, let's get right into it because the entire conversation on Wall Street has just done a complete 180, and it happened fast. Today, we're going to unpack this incredible reversal, a shift that has everyone asking a question that, seriously, just a few weeks ago would have sounded absolutely crazy.
And this really says it all, doesn't it? I mean, a month ago, the only debate was about timing. When is the Federal Reserve going to start cutting interest rates? Now, that conversation is dead. The new question is, could the Fed actually be forced to raise rates again? It is a total whiplash.
And this isn't just talk, right? The numbers show the story. Just look at the probability of a rate hike by the end of the year. It went from basically zero, a statistical impossibility, to over 20%. That's a huge jump. It means traders are now putting real money on the line, betting on something that was completely off the radar.
So what on earth caused this? How did we get here so fast? Well, the trigger wasn't some boring economic report. It was a major geopolitical shock that's now turned into a full-blown stress test for the entire global economy.
And it all centers on this, the Strait of Hormuz. Now, you have to understand, this isn't just some random body of water. It is one of the most critical choke points for global trade on the planet. Think of it like a major artery for the world's economy. And right now, that artery is being squeezed. The first and most obvious result? An oil price shock. And we're not talking a small bump here. We are talking about a massive surge of more than 60% this year alone. What makes this so dangerous is that it's pouring gasoline on an already burning fire, landing on a U.S. economy that's been battling high inflation for years. But listen, this goes way beyond the price you pay at the gas pump. This single disruption is sending a cascade of inflationary ripples out across the entire global economy. So let's just trace how this works, step by step. It's a domino effect. First, the conflict disrupts shipping. That immediately sends the price of oil and, crucially, fertilizer soaring. That, in turn, makes it more expensive to produce food and to make pretty much everything else. And before you know it, you've got this intense inflationary pressure building up everywhere.
And that's the key here, just how broad this impact is. The Strait is a major highway for fertilizers. When those prices spike, food costs go up for everyone, everywhere. It also affects industrial metals, things like aluminum and copper, the building blocks for construction and all our electronics. So when all these things get more expensive at once, inflation stops being a temporary problem and starts to get baked into the very fabric of the economy.
Which brings us to the Federal Reserve. All of this lands squarely on their doorstep, and frankly, they are caught between a rock and a hard place. They're facing this incredibly high-stakes dilemma with absolutely no easy way out.
Now, normally, the textbook response from a central bank is to just ignore an energy shock. They're taught to look through it, assuming it's temporary and won't last. But this time is completely different. The U.S. is already on edge after 5 straight years of inflation running too hot. The situation is just way more dangerous. And that leads us to this super important idea, inflation expectations. It's all about what we, consumers, businesses, believe will happen to prices. It's a psychological game. If everyone starts to expect high inflation, it becomes a self-fulfilling prophecy. Workers demand bigger raises, companies jack up their prices to cover costs, and you get stuck in a vicious cycle. The Fed absolutely cannot let that happen, especially after they got so much criticism for calling inflation transitory a few years ago. Their credibility is on the line.
So the Fed is walking this incredibly narrow tightrope. On one side, they can raise rates to fight off inflation. But if they do, they risk slamming the brakes on the economy so hard that it flies into a recession. But on the other side, they could do nothing. And if they do that, they risk letting inflation get totally out of control, which would mean they'd have to cause even more pain to fix it later. It's a terrible choice.
And, just to make things a little more complicated, you have to throw politics into the mix. There's pressure coming from the White House for the Fed to lower rates, not raise them. This raises all sorts of questions about the Fed's independence. Because if the market starts to think the Fed is making decisions based on politics, well, that could shatter confidence in their ability to do their job.
So, where does this all leave us? What should we be watching for to see what happens next? Let's check out the market signals.
If you want to know what the smart money is thinking, you look at the bond market. And right now, it is practically screaming. The yield on the 2-year Treasury note, which is super sensitive to what people expect the Fed to do, has jumped above 3.9%. That is a huge deal because it's higher than the Fed's own target range. The market is basically saying, we don't believe you. We think rates are going higher. Okay, so what would it actually take for the Fed to pull the trigger and hike rates? Well, they kind of have an informal checklist. First, inflation can't just be about oil.
It has to be broad, sticky, and bleeding over into other parts of the economy. Second, the job market would have to stay pretty strong. And third, the overall economy would have to keep growing. You'd likely need all three of those things to happen for them to make a move.
So here's the bottom line, the big takeaway from all of this. That comfortable story we were all telling ourselves, the one where inflation just gently floats down to earth and the Fed starts handing out rate cuts, yeah, that story is over. It's been completely ripped up.
And so that leaves us with a brand new question. We've gone from asking, when will they cut, to a much more sobering thought. If this new wave of inflation forces the Fed to act, just how high could rates actually go?